Euro to US dollar is ripping higher, 1.1470 as I speak, and if you're just waking up you see a strong bull move and think it's time to smash the buy button. Stop right there. What if I told you the real move hasn't even started, and the trap is being set right above your head? At 1.1500, a monster 2.3 billion euro option expiry is waiting like a sniper. One wrong step, and late longs get liquidated in a heartbeat. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay until the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the 1 headline that flips everything tomorrow. Write this number down. 1.1507. That's the immediate line in the sand. Our instant market verdict. We are in a strong intraday uptrend on the 4-hour and 1-hour timeframes, both screaming strong buy. The driver is clear. Overnight, US producer prices cooled more than expected, and that's piled on top of yesterday's weaker CPI. The dollar is getting hammered. DXY broke below 104.50, and the euro is surfing that wave. But here's where it gets dangerous. We are charging straight into a massive resistance cluster. R1 at 1.1466 we already pierced. R2 stands at 1.1507, and glued right to that level is a 2.3 billion euro option expiry, flagged by Citigroup's FX flow desk for the 10 a.m. New York cut. That is the gravity well today. Option strikes of that size act like a magnet for price, but they also act as a ceiling. The dealers who sold those options will defend that level aggressively unless macro flow blows through it. So you have to ask, who is more motivated right now, the breakout chasers or the option defenders? The CCI on the 1 hour is 182. Williams %R is minus 5.4. Both are pinned in extreme overbought territory. The probability of a sharp, sudden rejection at this wall is statistically high. Write this down. The single invalidation level that resets the entire bullish structure is the daily pivot at 1.1422. If we get a 4-hour close below 1.1422 today, the uptrend is done, and we go back to range or worse. The herd. Retail sentiment trackers show that small speculators have flipped heavily net long in the last 6 hours. Stops are clustered tightly above 1.1500 and just below 1.1420. This is a classic liquidity pull, and the institutions know it. They will gun for both sides. You must not be caught in the middle. Now let's walk the charts from the top down because this is where the real edge lies. On the weekly, we are still in a sell bias. That's the longer-term structure, price below the 50-week moving average, momentum still fading. That alone tells you that rallies into resistance should be treated with suspicion. The daily chart is neutral, but that's deceptive. Yesterday printed a spinning top right at the 20-day moving average, which was 1.1445 at the time, and today we broke above it with conviction. That 20-day MA is now at 1.1445, and it's acting as dynamic support. Above it, the 50-day MA sits at 1.1508, almost exactly at our R2 and the option expiry. The 100-day MA is at 1.1571, the 200-day at 1.1558, both converging in a band between 1.1550 and 1.1575. So any breakout above 1.1507 does not have a clean open road. It has another ceiling just 50 pips higher. The daily MACD is trying to curl higher, but the histogram is barely positive, and that tells you this push lacks deep institutional conviction yet. Drop to the 4-hour chart, and the picture gets more interesting. We have a beautiful series of higher highs and higher lows off the 1.1381 support. The moving averages are fanning out bullishly. The 4-hour ADX is at 25.8, right on the cusp of trending territory. When the ADX crosses 25 and you have a strong directional move, you respect it. So the path of least resistance intraday remains up, provided 1.1422 holds. But here's what most traders miss. On the 1-hour chart, I am staring at a hidden bearish divergence. Price has made a higher high at 1.1470, but the RSI has failed to confirm. The RSI high on this push is lower than the high it printed 6 hours ago. That is a momentum exhaustion signal. It doesn't mean reversal instantly, but it tells you the fuel gauge is blinking. Combine that with overbought stochastic and a massive option wall, and you have the recipe for a violent trap. The last time we had this setup was 3 weeks ago, and the euro dropped 90 pips in a single session once the divergence played out. I'm not saying it will repeat exactly, but I am saying risk. Reward strongly favors fading the breakout until proven otherwise. That is the signal that separates winners from losers. Just this morning, Bloomberg noted that TD Securities model shows leveraged funds have swung net long the euro for the first time in 2 weeks, piling in just before this 1.1500 wall. That means the late money is arriving exactly where the big option barrier sits. If the barrier holds, all that fast money becomes fuel for a stop cascade. And cross-asset linkage confirms the tension. The dollar is dropping, but look at the US 2-year yield. It's actually ticking higher, holding above 4.85%. That's a divergence. Normally a falling dollar aligns with falling yields. The fact that yields are firm while the dollar drops suggests this is more of a positioning flush than a genuine macro shift. The VIX is subdued, so risk appetite is present, but if Middle East escalation headlines hit, remember the core news flow flagged it, safe haven flows could yank the dollar back instantly. Bitcoin is hovering just below a key resistance, and S&P futures are flat. No explosive risk on confirmation. So for the next 1 to 2 weeks, my directional lean is cautiously bullish above 1.1380, but I will flip neutral on a daily close below 1.1422, and outright bearish if we lose 1.1381. The wildcard is tomorrow's University of Michigan consumer sentiment and PPI final demand. If those numbers surprise to the upside, the dollar could stage a vicious snapback, and that 1.1500 trap becomes the high of the month. I need you to interact right now. Do you think euro to US dollar breaks 1.1550 this week? Comment yes or no. I'm tracking the consensus in this community, and it helps me calibrate tomorrow's plan. Most people skip the trade setup section. That's exactly where the money is made. Keep watching. I am giving you 3 executable plans, 2 scalps and 1 swing. Each has a precise trigger, exact stop, and target logic. No guesswork. The first scalp I call the opening scalp, and this one is a countertrend fade at the danger zone. Here is the condition. We are watching the 5-minute chart. Price approaches the 1.1500 to 1.1507 band. You wait for a tap into that zone, and then you need a confirmation candle, specifically, a 5-minute bearish engulfing candle that closes back below 1.1500. That shows the option defenders are active and the rejection is real. Entry. Sell at 1.1498. Stop loss. 1.1520, just above the R2 resistance and the wick of the false breakout. That's a 22 pip risk. First take profit. 1.1470, the current intraday high area, quick scalp for 28 pips. If momentum is strong, you can hold a runner to 1.1445, which is the 20-period moving average on the 1 hour and a prior support. That would be 53 pips. Your risk-reward on TP1 alone is better than 1 to 1.2, and on the runner it climbs above 1 to 2.4. This trade is instantly void if any 5-minute candle closes above 1.1510. If you see a firm close above that level, the trap failed. Do not short. Move to the swing plan. The opening SCLP entry, 1.1498, 5M bearish engulfing after tap of 1.1500, stop loss, 1.1520 take profit 1, 1.1470 take profit 2, 1.1445 risk, reward, 1:2.4R, to TP2, invalidation. Void if any 5M candle closes above 1.1510. The second setup is the liquidity grab. This is a counter-noise scalp that preys on the stop clusters below the recent lows. Right now, the market knows there are protective stops from late long sitting just under the Asian session low, which lines up near the 1.1422 pivot. If we get a sudden spike down that breaks 1.1420, panics weak hands out, and then immediately recovers within a single 15-minute candle, that's the grab. Entry trigger, Price wicks below 1.1420, then a 15-minute candle closes back above 1.1430, forming a bullish hammer or a strong reversal candle. Enter long at 1.1432. Stop loss, 1.1415, placed just below the wick of the stop hunt. Risk is 17 pips. Target, 1.1470, the return to the intraday high. That's 38 pips, giving you a clean 1 to 2.2 reward to risk. This is a fast snipe, no second target, because you are just capturing the rebalancing back into value. Invalidation. If the 15-minute candle closes below 1.1415, the grab failed, and the structure is breaking down for real, then you step aside. After this strategy, I want every one of you to drop a comment right now. Are you scalping or swinging this week? Type scalp or swing. I want to see where this community sits, and I'll pin the most insightful plan.the. Liquidity grab entry, 1.1432, 15M bullish hammer reclaiming 1.1430 after a wick below 1.1420, stop loss, 1.1415 take profit 1, 1.1470 risk, reward, 1:2.2R invalidation, void if 15M candle closes below 1.1415. Now the session trade for those with wider stops and patience. The session swing. This one aligns with the 4-hour strong buy trend, but only triggers on a confirmed breakout above the 1.1507 option wall. The market must prove it can absorb those billions. The trigger, a 4-hour candle close above 1.1507. Not a wick, not an intrabar spike, a firm settlement. That close tells you the dealers have capitulated and the path is open. Entry, on the next 4-hour candle open, which I'll approximate at 1.1510. Stop loss, 1.1460. Why 1.1460? Because that sits below the broken A2 now support and below the 20-period moving average on the 4-hour chart, which is currently curling up around that zone. It also gives you a 50 pip stop, respecting the daily ATR of 59 pips. First target, 1.1550, the R3 resistance and the lower edge of the 200-day moving average band. That's 40 pips. Second target, 1.1600, a major psychological round number and the top of the weekly value area. That's 90 pips. Risk reward on TP1 is roughly 1 to 0.8, but on the full runner it stretches to 1 to 1.8. Once price reaches the halfway mark to TP1, that's 1.1530, move your stop loss to break even. That locks in a free trade. The entire swing is invalidated if we get a daily close back below 1.1460. That would signal a false breakout and a trap in the opposite direction, and you must exit the session SWNG entry, 1.1510, on 4H candle open after 4 hours close above 1.1507, stop loss, 1.1460 take profit 1, 1.1550 take profit 2, 1.1600 risk, reward, 1:1.8R, to TP2, invalidation. Daily close below 1.1468 30-second pulse on risk management. Never risk more than 1 to 2% per trade. For scalps, consider even tighter risk. No open positions through tomorrow's PPI and Michigan sentiment release. Stops are non-negotiable. If a trade invalidates, you get out instantly, no questions. This is how you survive to trade the next big move. Here is the single most critical level for the next session, 1.1507. That number dictates everything. If we reject there and lose 1.1422, the whole monthly consolidation flips bearish. If we close above on a 4-hour basis, we are targeting 1.1550 and 1.1600. Tomorrow's wildcard is the combination of US PPI final demand and consumer sentiment. If those numbers beat expectations, the dollar will roar back, and this breakout narrative could die. I will have an updated blueprint exactly 24 hours from now, mapping the new levels and the trap that emerges. Don't trade tomorrow without it if you want the full institutional breakdown on trading gold, Bitcoin, cable, and more. Those deep dives are live right now on the sister channels. Tap the end screen and the cards popping up, and you'll loop directly into the session start plan for those assets. Hold the like button until it explodes and subscribe with the bell. Every signal you send helps the algorithm bring you the exact levels that matter before the move happens. I'll see you in the comments. Let me know your scalp or swing plan, and I'll pin the best. Trade smart. Scalp the noise. Swing the trend.